March of 2015, we have a total solar eclipse. This also happens to be the spring equinox day. On April 4th of 2015, we have the third blood red moon. This is followed by the Feast of Unleavened Bread and then the Feast of First Fruits. Within May of 2015, we have Pentecost. Following the line here for the Shemitah year, we come to what will most likely be the most significant prophetic month on our horizon. The most significant prophetic month on our horizon. The Shemitah ends on Elul 29. This is September 13th of 2015. This is the Harbinger warning. This significant date is followed by the Feast of Trumpets right after it on the 14th and the 15th. The Feast of Trumpets is followed by Yom Kippur on the 23rd, and then we have the final, the fourth blood red moon. I think you'll agree that that's a lot of activity for just 1 month, and it's hard for us not to read too much into Elul 29 occurring, followed by the Feast of Trumpets, all of which occur within the pattern of the 4 blood red moons, the tetrad.
We're talking about a prolonged depression. We're talking about massive deflation, massive unemployment, rampant bank collapses, a 70% best case scenario stock market drop. This could all start within the next 6 months.
Recently, all 16 branches of our intelligence community have come together to release a shocking briefing that contained an alarming consensus. These agencies, that include the CIA, FBI, Army, and Navy, they've already begun to estimate the impact of the fall of the dollar as the global reserve currency, and our reign as the world's leading superpower being annihilated in a way equivalent to the end of the British Empire post-World War II. And the endgame could be a nightmarish scenario where the world falls into an extended period of global anarchy.
There's now concern in different branches of the U.S. government. Historically in Washington, the Treasury and the Fed take care of the dollar. The Pentagon and the intelligence community take care of other threats. But what happens when the dollar is the threat? Americans generally know that the Fed has increased the money supply by $3.1 trillion. We have $17.5 trillion of debt. We have $127 trillion of unfunded liabilities. What are those? Medicare, Medicaid, Social Security, student loans, Fannie Mae, Freddie Mac, FHA. You go through the whole list, and it goes on and on and on. There's no way to pay it. During the boom years of the 1950s and 1960s, every dollar of debt that was created, we got $2.41 worth of economic growth. So that was pretty good bang for the buck. But by the stagflation of the late 1970s, that had actually collapsed. So now for a dollar of debt in the late 1970s, we were only getting 41 cents of growth. So obviously that's a huge drop-off. You know what that number is today? Today we only get 3 cents of growth for every dollar of debt. So we're piling on the debt, but we're getting less and less growth as that trend goes from $2.41 to 41 cents to 3 cents. It's soon going to go negative. This is a signal of a complex system about to collapse. It's the ratio of stock market capitalization to GDP, because remember, the value of all the stocks in the stock market, that's supposed to represent the fundamental economy. It's not supposed to be off in a world of its own. But if you look at what's been happening to that ratio recently, it's going sky high. It's 203%. Prior to the recession, that number was 183%. Go back to the famous tech bubble, the dot-com implosion of 2000. At that time, it was 204%. And if you want the scariest news of all, just prior to the Great Depression, that number was 87%. In other words, the stock market capitalization as a percentage of GDP is twice as high as it was just prior to the Great Depression. So that's a really good metric for saying, hey, is the stock market heading for a crash? All the data says, yes, we are. But there's another metric, another warning sign, if you will, that's even more frightening, which is the gross notional value of derivatives. There's a certain number of shares of IBM that are outstanding, but we know what that number is. But there's no limit on the derivatives. I can write options and futures on IBM stock all day long and all the other stocks on the stock market. And that's what's been going on. Now, the gross notional value of derivatives in the world today is over $700 trillion, not billion, 700 trillion. That's 10 times global GDP. This collapse is unavoidable. So, we ask ourselves, how bad can this be? Well, what happened in 2007, 2008 when the markets collapsed? We all remember the value of stocks going down, real estate going down, housing going down. All that lost wealth was $60 trillion. The problem is now the system is bigger, so I would expect the lost wealth this time to be $100 trillion, possibly a lot more. We're in this critical state, getting close to the supercritical state where the system implodes. But it takes a catalyst. It takes a flashpoint. There are a number of potential flashpoints.
Funded liabilities, excessive government spending are basically
depression. That word brings to mind images of the 1930s and soup kitchens.
Well, we have soup kitchens today. They're just at Whole Foods in your local supermarket because 50 million Americans are on food stamps. It's not that we don't have distress. We have enormous distress, but it's being hidden in different ways. The unemployment rate today is actually 23% when you calculate it the right way.
And you point the finger right at the Fed, Congress, the White House.
I actually was in a meeting in the Treasury, and I said to the audience, the Fed and the Treasury are the greatest threat to national security, not Al-Qaeda, not some of the other threats out there, but right here in this building with this group, you people are destroying the dollar, and it's just a matter of time before it collapses. And I testified before the United States Senate about this. I warned the Senate, maybe we can't stop earthquakes on the San Andreas Fault, but nobody thinks it's a good idea to send the Army Corps of Engineers out there and make the San Andreas Fault bigger. But by money printing and credit creation and reckless monetary policy by the Fed, we're making the San Andreas Fault bigger every day. And when you make a complex system bigger, the risk doesn't go up a little bit, it goes up exponentially. So the risk is unimaginable at this time. The collapse hasn't happened yet, but the forces are building up, and that's just about to snap. Let's look at what's actually happening with the velocity of money. It's plunging. It's going down very rapidly. But compare this decline of velocity today to what we saw leading up to the Great Depression. Now, in the depths of the Great Depression, velocity was even lower. But if you compare what's going on today to what happened in the late 1920s, just prior to the Great Depression, there's a very striking resemblance. So it doesn't matter how much money the Fed prints. The Fed is trying desperately to bend the curve. Think of it as an airplane that's coming in for a nosedive. It's crashing, getting close to the ground. The Fed's trying to grab the joystick and pull the plane up out of the nosedive and get it back in the air. But unfortunately, it's not working. We're heading for a crash. The problem is not limited to the Fed. It's infecting the private banking system as well. There's about $60 trillion of debt on the balance sheets of our banking system. For a long time, debt in the banks grew at about 2 times the rate of growth in the economy. But lately, this has exploded. Today, it's up to 30 to 1. In other words, for every dollar of economic growth, there's $30 of credit being created by the banking system. The whole thing's unstable. There are a lot of signals out there, and they're very, very troubling. One of the ones I'm watching closely, and I know people in the intelligence community focus on also because it covers so much ground, is called the misery index. The misery index is when you take the unemployment rate and you take the inflation rate and add them together and then just sort of chart that. You look at the misery index today compared to the period of stagflation in the late 1970s and early 80s that Americans remember so well, it's actually worse. This can lead to social instability. Take this back to the Great Depression. The misery index in the Great Depression was at 27, but today it's at 32.89. Believe it or not, it's worse today than it was during the Great Depression. What happens as the depression worsens? Businesses can't pay their debts. The bad losses fall on the banks ultimately fail. That's happened before. The Fed's there to bail out the banks. What happens when the Fed itself is in jeopardy?
Based on these signals you've been tracking, the Federal Reserve is going to fail?
The Federal Reserve actually in some ways already has failed. Look at this chart. What it shows you is that the Fed has increased its capital. It's currently about $56 billion. That sounds good. You say, gee, $56 billion is a lot of money. That's a pretty good capital base. But that's not the whole story. You have to compare the capital to the balance sheet. How much in the way of assets and liabilities is that amount of capital supporting? When you look at that, it's a much scarier picture because the actual liabilities, or debt, if you will, in the Fed's books are $4.3 trillion. So you've got $4.3 trillion sitting on this little skinny capital base of $56 billion. That's very unstable. Prior to 2008, the leverage was about 22 to 1, meaning they had $22 of debt on their books for every $1 of capital. Today, that leverage is 77 to 1. So yes, the capital has increased, but the debt and the liabilities have increased much more.
Regardless of which flashpoint unleashes the 25-year Great Depression, folks need to understand it's coming, and coming quick.